Okay, good afternoon, everybody. Welcome to 2024. This is your weekly take on the market. Today is January 5 of 2024. It is about 12:50 my time, so the market is almost closed. I have a meeting at 1:30, so I have to get this done in the short period of time. I waited and waited because the market's been, not super volatile today, but I was curious if it was going to try to rally today, but and it looks like it's given back a lot of those gains, and so that would influence the end of the week. The end of the week is, I think, the markets is very U-shaped to me. Like the price action Monday is really important. Tuesday through Thursday, a lot less important. Friday, especially as you get to the close, is super important because it just what are they willing to the institutions at what price and at what are they willing to take home? What are they willing to hold over the weekend, so to speak. So, um, my name is Scott St. Clair. I'll be your host. I got off track there. I went out of order. I am the manager of the Premium Product Group here at Investors Business Daily. This is our disclaimer. I will update this later for 2024, but it's the same. I'm not licensed. Nobody at IBD is licensed that I'm aware of. Don't make buy, sell, hold recommendations for educational purposes only. Market thoughts. I'm going to skip the industry groups just for the sake of brevity because I have a lot of thoughts on the market and then a lot of stocks that I'd like to cover, and then the quote of the week. So this is okay. So this is an old screenshot. I was doing some research on the January barometer, and I like this screenshot. So it's from February 1st of 2023 from Fidelity. And it's the old, as January goes, so goes the market. And in 2022, stocks, excuse me, the stocks lost 6% in January, and it led to, kind of foretold a bear market. And then in January 23, stocks were up 5%, and in hindsight, it foretold a bull market. And I believe in cycles for sure. And birds fly south for the winter. Whales migrate back and forth, right? And so um, it makes sense, although the market can sometimes deviate. But as a general rule, I believe the probabilities are, if you're thinking about cycles and seasonality, et cetera, it can work in your favor, over a number of sample points. Not any one year the market can do anything, which is why in the end, Bill would say, I don't know what the market's going to do. If somebody were to ask him what's the market going to do in 2024, that's kind of, if you're in this business, that's like the worst question to get from a friend or your uncle or something, because it's hard for you to say, well, I don't know. It's like, what do you mean you don't know? Aren't you in the business? It's like, well, I don't. Yeah, I am, but I don't know. I don't know what the market's going to do here, and so I'll watch it day by day, week by week, and evaluate it accordingly. So, but so far for January, it's only 4 trading days in. I think the market's, relatively weak. Nasdaq's down about 3.5% for the week. S&P a little bit less, and we'll go through that. Election years, another important seasonal pattern. So you have an open field, all election years, sitting president, which is what we have right now. But and look, the politics is borders on one of my least favorite things, just because it's so it just creates so much tension and angst amongst both sides. And my 2 cents is they're all turkeys. But anyways, I try not to get involved, but I do watch sort of because it does influence the markets for sure. So we're sitting president running, which is presumed that Biden will run, but you also have the idea that maybe as we get closer, it could become a semi-open field. And there's a lot of uncertainty with the election. So that I think that could lead to a lot of volatility as we get closer and closer, which is why I think this year is going to be pretty volatile. It's just my 2 cents, both ways. Volatility works both ways. Everybody's afraid of volatility as general rule. If you told anyone the market's going to be volatile, they'd be like, oh, well, volatility works both ways. It goes up a lot more than it probably should. goes down more than it probably should. And that's what people are afraid of, but it works the other way as well. So I don't mind volatility too much. If it's too extreme, you can't manage your risk, like a COVID bear market type volatility where you come in one day and in the S&P is down 5%, or if you're short, it's up 5%, or like the 08-09 crisis, the teeth of that. In hindsight, it seems real easy. Just be short. Well, as somebody who was shorting that, it wasn't that easy. It's pretty volatile, and you can get run over. I mean, I was short Fannie Mae and Freddie Mac. I can't remember if I was short both of them, but I was definitely short Fannie Mae, and it was up 20% one day, and I was just getting run over. Eventually, it went to zero. I was right, but what good did that do me when I had, I'd stop myself out. Who could take the pain of a single position up 20%? Not in the kind of size that I'm using. So I just think it could be pretty volatile. So the cycle says could be down for a couple the first quarter, down to flat, and then a rally into the election, and then it kind of depends on what happens with the election, who wins, and then all bets are off. But this is why I think a lot of this back and forth. Q1 of election year tends to be weak. You have 73 years of data, if I did the math right. This is from Carson Investment Research. Benchmarking. So more and more investors, and when I say investors, I mean money managers, active money managers, are hugging the benchmark. And it makes sense in times of uncertainty. It's a weird business. Like to go out on the risk spectrum, to be different, running big money creates a lot of risk. You better be right. And I just think that a lot of them have made the decision that it's not worth the risk reward. You might not, if you haven't been in the business as long as me, you might not recognize the name, but I remember distinctly Jeffrey Vinnick, who was the manager of the Fidelity Magellan Fund in the late 90s and was the manager for a long time, and had a tremendous track record for a mutual fund manager and a stellar reputation as a strong fund manager. You might want to, if you're unfamiliar with him, I don't think he's ever written a book. I would love to read a book if he had, but you could probably find some articles on him. And he was running a lot of money at Magellan, a lot of money. And I don't remember what year it was, let's say 97, 98, 99-ish. He started to get bearish, and he started to put the Magellan Fund assets in bonds, started to move a lot of the money into bonds. And what happened? Well, the market went up in 97, it went up in 98, and it really went up in 99. And so he underperformed, and I don't want to say he was pushed out, but I think he left in late 99, 2000, sometime in that time frame. And he went off to open a hedge fund, and I think he did pretty well at his hedge fund. Jeffrey Vinnick's doing fine. Don't worry about him. He's doing more than fine. But he was right. He was right. We went into one of the worst bear markets in stock market history, but he wasn't around to reap the rewards. And I think that's a story that a lot of managers are aware of, and they have career risk. And career risk is a very real thing. Whereas, I'm assuming most of us who are listening, and don't have that. And so it's a big advantage not to have that. You can underperform. Like last year, the NASDAQ did 50%. I did not do 50%. So NASDAQ beat the pants off of me. Just kind of my benchmarks, and should be the way that I trade them, aggressive stocks, etc. And so in that 1 year, I'd have been better off in the indexes. But I'm more worried about 10, 15, 20 years. And I don't have to worry about getting fired. I haven't fired myself just yet, although I've had some years where I probably wish I had. So it is what it is. So hugging the benchmark's a real thing, and it's getting it's happening more and more in the most last couple of years. All right, technology, no surprise to anyone. It's way through the roof. As high as it's ever been as a ratio versus the S&P. Does that mean that it has to end? No, but I just keep in mind there's just not a lot of value add in this area. Meta, Microsoft, Apple, Nvidia. These, sorry, the bell just went off and startled me. These are all well-known names, and there's just a million eyeballs on them, and so I just don't see how there's any advantage to those names. Now I do own Nvidia, and I'm like a torn because the chart, everything about Nvidia looks so good, but the sentiment on Nvidia is as bullish, as extreme as you can get. And I see people posting, this is a perfect canceling model book stock, and this stock's going to 1,000, and it just makes me a little nervous. But I am in there with the idea that, I'll get out if I'm wrong. I'm not gonna. I have a plan. If it goes the other way. Okay, let's pull up the indexes. And all right, here's the NASDAQ. You can see it looks like it's going to try to close blue, give or take. Not a great day, not a terrible day. You had the jobs number, and the market was lower in the pre-market and then tried to rally. The market feels a little heavy to me. You are, for the week, down 3.25%. I think the 50-day or the 10-week is your next stop. I think that you're probably, you're on here, you're 2.5% above it. So I could see this happening next week, something like that. And then we'll see if we get a bounce. I don't know if you saw on IBD Live, I said, I'm not bearish. I don't think we're going to get like a big bear market, but the run up into the market this late last year reminded me a lot of the 1999 bull market. And so I felt like the start of the year would be poor, because that's kind of how it turned out then. So I'm super not bullish is the term that I used, I think. So, and if that makes any kind of sense, not over, I don't foresee a big bear market. It just seems unlikely. But it felt like the sentiment, podcasts, I saw some podcasts where people were saying, it doesn't get any better than this. And I'm like, well, if it doesn't get any better, it's only going to get worse. Even if it's only marginally worse, that's enough to take the market down. And one guy said he was as bullish as he's ever been, and it was the best buying opportunity of a lifetime. Another guy said, and I thought, has he ever seen a monthly chart of the market? Is this the buying opportunity of a lifetime? I think this one, of course, for some of us, but this one, the 09 bottom, it was generational low, that type of stuff. So I'm just not bullish. So I have some shorts, I have some longs, and we'll see how it goes. The S&P, so up a little bit as well. So it's doing kind of what it's supposed to do. The consensus is that the market had to pull back, and so for me, the consensus is not always, but mostly wrong. So I don't think it's going to be just the pullback. I think it's going to be a little nastier than that, something to really shake them out. So that's my 2 cents. Something that does that, I think, is probably that's how I'm playing it until proven otherwise. But I'm also looking for longs that are relatively strong. So Nvidia, relative to the market, was a great day. It was up while the market was barely flat. CrowdStrike, on the week was down 3%. Now, that's barely better than the NASDAQ, but when the beta is 1.6 times the NASDAQ, that should be down. If the NASDAQ's down 3.25, it should be down about 5%. It wasn't. So that type of stuff I'm looking for to know, like CrowdStrike, market gets better, go-to stock. NVIDIA, market gets better, obvious go-to stock. I have small probing positions in both those because I find it easier to add to them than just to buy outright. And because I have some shorts, if I'm wrong on these, hopefully my shorts go down as much or more, and it doesn't hurt me to be long, even though I'm not super bullish, if that makes sense. Okay, I jumped around. I was on the indexes and I jumped to these stocks. So there are two. I am long Japan. A little frustrating. That got as high as 64.19, which would have been almost a closing high, and didn't close all that great. But again, this is what I'm looking for: relative strength. So the S&P was flat and Japan was up 0.75%. If I ran $10 billion and I was long Japan 5 billion and short the S&P 5 billion, I would have quite a day. That'd be a great day, and I'd be market neutral, so to speak. So that's I'm just looking for relative strength. EWZ as well. Do you have a position there? Again, not a great close, not super great action. It's fine. It looks okay. Up 1% while the S&P was down. So while the market's going down, what you should be doing is looking for those stocks that don't want to go down. And I have, at least for me, a list of them, and we'll see. Okay. Let's I'm gonna pause my screen and then make sure I resume it correctly, because otherwise I'll be doing this again. That has happened to me many a time. And so there's something wrong with it. It doesn't allow me to do that. Let's go resume share. Okay. All right. So let's get into stocks to watch, and then we will do the quote. So relative strength, like I talked about. So like Vertex. This is a bull market pivot. It's not, it's not a great pivot, but Vertex, the RS line, is basically finally at new high and holding up really well. So I don't own this. I've been, Vertex, one thing about Vertex is it's big, super liquid. Takes some patience to make money in Vertex. So it's gone nothing but up, but for some reason I can't make money in it. So I have to consider that with a stock like this. Yeah, you have to kind of be patient, and it might not be the right stock for me. I'm wondering, but definitely leadership. Lilly tried to break out and got but to me, you gotta, these kind of alternative, these earlier entries. This is why I like to probe and add. Is I think that was the day. Like if you're interested in Lilly, you've got to buy it that day. I mean, worst case, you buy it on the close. Next day it gaps up. You can add if you want, but I would maybe add a little bit. Like if you owned 1,000 shares, I would add, maybe 200, something like that. And then when it breaks out, you can buy it if you want. It could keep going, but the breakouts are tough. So maybe you buy another 100 shares. And then if it reverses, you don't get so top heavy. Whereas if you buy 1,000, you buy 500, you buy 500, you buy here, you've kind of given up most of your gains or a lot of it. And it's, you have a really big position because you've added. So you gotta be careful, for lack of a better word, about that. The key is get that initial position. Sometimes Nicholas Darvis. So I might buy like 100 shares just to get a position, and then close on the high, boom, buy 400. And I know that's not the right way. That's not the CanSlim way, but That's how Nicholas Darvis would do it, and I kind of like that way. It makes there's pros and cons to both ways, obviously, but I kind of like that way. So that's more how I would do it, for what it's worth. Lilly in that same category. I'm sorry, NVO is what I meant, in that same category. So had a nice move, and then not they're fine. These are stocks probably that just need to be held, which is why it's a little difficult for me, because you just have to kind of 3 steps forward, 2 steps back type stocks. I mentioned CrowdStrike. So I like, at one point this was blue, which looked like a good support day, but I like that, the market was bad that day and it was blue. So that's kind of my entry. I think this is a go-to stock. If the market's fine, I think CrowdStrike will break out above that, a month, 6 months, 9 months from now. I don't know when, but that'll probably happen. I think CrowdStrike is firing on all cylinders, right group, earnings, sales, etc. And let's do the the Nvidias of the world. So let's turn the pattern rack on. You see, you got a nice little base on base, which is pretty powerful. I like that. I like the fact that it broke out, quote unquote, failed, and now it's just sitting there, base on base. So again, scratch the name. If I couldn't see what the name was, earnings up 593%. It's in a flat base, relative strength of 97, on and on and on. It just screams that I need to be owned. The other factors are ancillary, secondary, but they influence me. The number of eyeballs and everybody's, it's just not a secret anymore. And I've seen the AI thing. I just don't know what inning we are in. Are we in the first inning or pre-game? And then I assume that NVIDIA is going to be a leader in that, but I don't know. I'm going to let the market tell me. So, but this is so compelling that I don't want to get left behind if it goes on another leg. And it's possible. If you look at like Qualcomm, something like that in 2002-ish. I might have gone too far, but let's go to 2001. And I lived this. I just thought, oh, well, how much more can it go up? Like right there in June of 1999. like that. I mean, and I apologize. I'm still trying to kick this cough. That's a very difficult buy. Like, how many people would want to buy that? Oh, geez, it was 30. Now it's 120. Where's it going to go? Well, hold my beer. Fast forward 3 months, and now it's 180. And then it's like, well, I can't buy it there. Fast forward another 3 months, and it just rockets from 180 to 450. So NVIDIA could do something like that. It's not impossible for that to happen, and I want to be on board if it does. So if I'm wrong, I'll get out and lose a little bit. But if something crazy were to happen, you could make a bloody fortune in NVIDIA, because you can have size in there with confidence and sleep at night. It's not going to gap down 20% on you. At least I hope not. Okay, NVIDIA, let's go to like Meta. So I know that I saw that Mark Zuckerberg sold $1 zillion worth of stock, which is very interesting, because last time he was a seller, it led to a big sell-off in Meta. So I don't own Meta and probably won't own it. I don't use Facebook. I use Instagram very, very little. So I have a hard time with the product, because I'm just not it's not a contributor in that regard, but it looks fine. Microsoft, it's starting to get a little sideways action, but looks okay, obviously. Google. So the pattern looks okay, but you can see, look, they're losing relative strength because they're going sideways while the market went up. Amazon, I think somebody said, besides the 2000-ish top. This is the longest time frame that Amazon has been without making a 52-week high. I'm sorry, an all-time high, I think. So it's been, is that higher than that? Let me see here. 188.11, 188.65. Really, really close. 188.11. Yeah, so it's actually this one, which was July 2021. So a long, long time where it hasn't made a high since obviously this debacle. But so interesting. Economies of scale may be kicking in on these names. Apple, really relative strength poor. I think Apple's an avoid, but I've said that before. I think if you're running big money and you wanted to try to outperform, you wanted to avoid the benchmark without like a zillion pounds of career risk, you'd be underweight or out of Apple. And I think you'd be glad to like fast forward a couple of years and see how that plays out. What else is out there? As far as on the short side, Blackstone to me is a great canary in the coal mine. That doesn't mean it's a great short. That's obviously for you to decide. But Blackstone has their hand in all the cookie jars that are quote unquote toxic. PE, venture capital, commercial real estate. I listened to Carson Block, who's a short seller, talk about BXMT. Is that the? Yeah, this one, Blackstone Mortgage. I listened to a podcast about how, the stuff that they own, the commercial real estate on this one. And, obviously he's short. He's going to tell a compelling story, but I don't want to short this because of the yield that it pays, 11%, and probably a tough borrow. But Blackstone looks, and it's a market barometer too. It's going to have a hard time going up if the market's in trouble. So I think it's a good barometer to watch for how the market trades. Like in hindsight, I was watching Schwab so closely, and I was really nervous about Schwab down here, because my money was going to end up there from TD Ameritrade, and there was a lot of talk about their balance sheet, and it just like right there. Look at that on 11/29. What a signal! If something was wrong, if there was something wrong in the in the macro world, Schwab wouldn't be up 7% that day coming out of this little area. So it was a really good signal that the market was better. In hindsight, I didn't take that signal, unfortunately, but this is the work that you do. And maybe next time, the alarm bells will go off for me. Like, hey, dummy, if something's wrong, XYZ shouldn't be doing this. Really, works both ways. Blackstone. What else? Oh, I didn't mention Tesla. Tesla, today was a very interesting day. Like it couldn't rally at all. Didn't go down a lot, but it's very, like it didn't trade hardly at all, which is very unusual. 234 to 240, 6-point range. So I'm tempted, but not in any hurry. I think Tesla is a short 230 and lower, and I think it's a buy 270 and higher. And I'll just wait. But it's another good barometer to watch. What else is out there that I have to look at? Sometimes I forget what I wanted to talk about. I think that might be it. I feel like there's one more name that's on the tip of my tongue that I wanted to discuss. I'm looking at my sheet here. Oh, I know. I wanted to talk about was AMR. Boy, did I drop the ball on this one. So, I mean, I'm literally long there. Ugh. There's something to be said for holding and holding, right? I would like to get better and better at that. But it's just, I love the fact that AMR outperformed NVIDIA in 2023. It's just, it just shows you that anything can happen in the market. You've got to be looking around. You got to be aware of what's going on and where the strength is, and you got to be open-minded to buy something that you know. And we all have biases. Steve Birch used to always tell me, he is the CEO, I think is his title, William O'Neill, and he was the guy that ran the portfolio management side, and you would meet with him, and very sharp guy and great track record. And he always tell me that, in everyone, he'd say the same thing in the meetings, like, we all have biases and you have to try to overcome those biases, but be aware of them. He goes, he loved technology stocks. So he says, I have a bias. I just give every technology is going to be the greatest technology ever. And he would give that the benefit of the doubt. And sometimes that would help him and sometimes that would hurt him. But I think he's probably made a boatload in NVIDIA because he loves that type of stock and that type of technology. But yeah, if you have a bias, it's coal, where can it go? How can it go up? Blah, blah, blah. And, and just a rocket ship. So you have to be open-minded and flexible to all the names as best you can. It's not easy, but as best you can. All right. I got 10 minutes here till my next appointment. Let's go to the quote of the week. Meriton Parker, I hope I pronounced his name right. Unknown Market Wizards. I reread that book. I love that book. I think I have one more chapter, but on a reread, and this time I'm studying, highlighting it, and marking down things that are important. So I thought it was a very good book. I think I liked it better the second time, if any of you have read it the first time. He says, and this guy was very interesting. I think it was him. He actually started out, with Investors Business Daily and canceling stocks and following breakouts and stuff like that, and adapted into a system trader. But he uses a system stop, which I think is very important. So if he's down 10% from a starting level or 15% from an equity high after I was ahead at least 5%, he would use a stop. He would get out and reevaluate it. So I always start at 0 for the new year. So in other words, I start at 0. If I'm down 10% at any point to start the year, using his system, I would be like, okay, go to cash, reevaluate, figure out what's going on. 15% from an equity high. Let's say I was up at $1 million into 150,000, just to make the math easy. And after I was ahead at least 5%. So that would be ahead 5%. So then I gave back 15% of that, 1150. Well, that would put me into negative. So I'd probably, because that 15 up 15, down 15. Let's say 20%, up 15. Anyways, once you go down 15% from an equity high after being up at least 5%, that would be a stop as well. I think it's a very good strategy as well. So you should always have some kind of a stop on your whole account, where not that you stop, you could stop trading for a day, a week, a month, take a break, try to reevaluate, but you just protect your account equity. So I always have a stop on a stock, and a mental or actually with the books, something where, time to go on XYZ. But I also use that for my accounts. And that will protect me in times where I'm just out of sync and don't really have any, for whatever reason, I'm just not seeing the ball in a baseball term. So I've got to have some type of stop. He'd always had a 20% system stop. So 20% at any point, he would stop out and reevaluate. And he says, I now have a system. If the equity curve goes below its 200-day moving average, I have a stop for that. And so I have a equity curve on all my accounts. And I do use a moving average. It wasn't a 200-day moving average that I was using, but I think I'm going to add that now after reading this. So am I above the moving averages on my equity accounts, like the markets? Are the markets above or below the moving averages? sometimes just it can be that simple. You you want to know what the market's doing. Was it above or below the moving averages? It could be in between some of the moving averages, then it wouldn't be so simple. But you should have. I wouldn't have a bunch of moving averages. I think the 50, the 10-week, the 40, or the 200-day, more than fine. You want to add a shorter term one, maybe you can use a 21-day or something like that, but that type of stuff. Okay. Contact information, marketsmith@investors.com, 800-424-9033. I know that just an FYI, some of you are using the reach us at marketsmith.com email address, and you just had it in your calendar, or I'm sorry, your Outlook or whatever forever. That email is going to go away in a month or two here. It's not going to be, it's going to kick back and say, we don't exist. So please update your email contact with us if you're using that one. Do not use the reach us anymore. Use marketsmith@investors.com. Very fitting that I ended the video like that. Thank you guys. Have a great weekend. I think we will see you next week. Bye-bye.